Gold is moving from west to east, and it's changing the gold market. But why is it shifting, and does it matter? Let's find out. We're nearly 6 months into 2024, and we've hit a record high in the gold price. And while Western gold buying has remained healthy, it is nothing compared to the East, where we've seen strong buying into the price surge. So where is this demand coming from, and does it matter? First up, the obvious one, central banks. In the context of heightened geopolitical uncertainty, recent price hikes have found support in robust demand from various central banks in both emerging and developing markets. Gold, being a sought-after, safe haven asset, typically sees price surges during periods of geopolitical tensions and policy ambiguity, and the last couple of years has offered this in spades. The first quarter of this year saw a surge in gold demand, primarily fueled by significant central bank purchases, notably from China, India, and Turkey. And particularly noteworthy is China's central bank, which extended its streak of monthly gold purchases to 17 consecutive months in March 2024, setting a new record for consistent monthly acquisitions. Demand for gold by non-Western central banks is nothing new. 2022 saw the largest purchases of gold by central banks since records began more than 70 years ago at 1,136 tons. And you can see from this chart from Incrementum the extent to which institutional demand for gold has shifted to the east. It compares the cumulative gold sales of Western central banks with the cumulative gold purchases of the Shanghai Cooperation Organization since 2001. And of course, we can't talk about the shift in gold demand and suggest it's just central banks. Let's bring this down a level or two. It's not just central banks or government policy that is driving gold demand. It's happening at a microeconomic level as well. According to the latest World Gold Council report, demand for bars and coins is anticipated to stay robust, with China playing a significant role. The first quarter of this year was the strongest quarter since 2017, and favourable factors contributing to this trend include enhanced household finances, challenges in domestic equity and property markets, as well as currency instability. Now, these conditions create a conducive environment for maintaining solid gold demand level. For instance, Chinese consumer demand has surged between 2000 and 2024, nearing a 200% increase. Similarly, annual consumer demand in India has risen since the millennium, starting from a high level already in 2000. And together, China and India, which represented only 29% of consumer demand in 2000, now make up nearly half of global consumer demand, reaching 48.4% in 2022. And just as a quick side note, China is both the number one producer and consumer of gold. And this is pretty incredible when you consider that it is really only in the last 25 to 30 years that the market was liberalized and Chinese citizens have officially been allowed to buy gold. And what's happened in that time? Well, we've seen a rise in real incomes, a rapid growth in the middle classes, but also in the last 5 years, an outpacing of household savings growth over loan growth, despite the pandemic. And this is a stark contrast to the USA, where savings have been disappearing as households fight to keep up with their debt repayments. And where are a good chunk of those savings going? Into gold. Now let's also consider where this demand is coming from and how it is driven by the militarization of money. In February 22, just days after Russia's invasion of Ukraine, money was weaponized on a level that had not been seen before. US and European governments made the decision of unprecedented proportions to freeze half of Russian central bank's gold and foreign exchange reserves. They also agreed to cut off major Russian banks from SWIFT, the world's dominant financial messaging system. Unsurprisingly, policymakers in emerging markets are increasingly concerned that potential economic sanctions from the US and Europe could abruptly block key financial channels reliant on the euro and dollar. And additionally, there's apprehension that these sanctions could lead to the freezing of assets denominated in dollars and euros belonging to central banks, major trading partners, or political figures in emerging markets. In August 2023, 18 months after the invasion of Ukraine, South African President Cyril Ramaphosa cited concern that the global financial and payment systems are increasingly being used as instruments of geopolitical contestation. And India's central bank has been even more dismissive of the West's actions, saying that they are exploring alternatives to the euro and dollar, partly because having strong foreign exchange reserves in an increasingly polarized world no longer seems a sufficient defense against the threat of economic sanctions. And this brings me to another point, the independence that owning gold can give you. And it's not just about setting yourself up as a buyer, as we're seeing in the East, but also setting up new markets for themselves. We can talk about all the buying of gold that they're doing, in an effort to reduce reliance on the Western financial system. But the real way to do this is not just by stocking up on gold, but also by producing gold and providing the infrastructure by which it can be traded. And we know that China and Russia sit in the top 3 gold producers, but they, along with the UAE, are enhancing their gold trading infrastructure. And this move aims to establish a lasting framework for diverting gold trading away from Western hubs like New York, London, and Zurich. And this shift underscores a changing perspective on roles. The East is increasingly positioning itself not merely as a consumer of Western infrastructures, but as a provider of the infrastructure itself. So what are we looking at here? Well, we see collaboration between China and Russia to bolster their gold market ties through cooperation between the Shanghai Gold Exchange and Russia's National Financial Association. This collaboration is expected to deepen further given the surge in Russian gold exports to China amid Western sanctions. And then we have membership in gold-related institutions. With the shift of gold flow from west to east, Eastern gold markets are gaining prominence and representation in global institutions like the LBMA and the World Gold Council. And China has significantly increased its presence in these institutions over the past decade. And then in India, we see the International Bullion Exchange. Alongside its well-established over-the-counter market, or OTC market, the inaugurated Indian International Bullion Exchange is now facilitating spot gold contracts trading. And then we have the establishment of the Moscow World Standard. And then in Russia, in response to Western sanctions, Moscow is setting up an independent precious metals trading infrastructure, including the Moscow International Precious Metals Exchange, and introducing the Moscow World Standard to challenge the dominance of London and New York in global precious metals pricing. All of these developments underscore a significant shift in the global gold market dynamics, with Eastern markets increasingly asserting their influence and autonomy. And when we're thinking about all of these things and bringing all of these factors into account, think about what this says about priorities and how we are choosing to think about our money and how we use it. At the beginning, I asked if it mattered that the East is buying up all of the gold it can afford. Well, for the past 3 weeks, the gold market has stabilised near $2,350 an ounce, as the Federal Reserve has indicated its hesitance in initiating further easing measures due to the persistent inflation levels. And this is still a focus for Western gold buyers, but in the East, it's another matter. The actions of the Fed and the data coming out of the US is becoming secondary to those in the East who are quickly shifting from being price takers to price makers. They are steadily building their fortress against the Western dominated financial system. And all of the factors that we've just discussed are forming part of that fortress. If you already own gold, then this is a good sign. But if you don't, then you're at risk on 2 levels. First, because you're unlikely to benefit from a gold price rise if you don't own gold. And if the gold market continues to be supported by the East, then that is indicative of their sentiment towards not only their own finances, but the pressures placed on them by the global financial system. Keep asking, why are citizens, institutions, and central banks of the East buying gold? It's not because they think everything's tickety-boo, let me tell you. So what does all of this mean for us? It means there's no plan B. We are witnessing a shift of wealth from the supposedly advanced nations of the West to the East. And if, or more like when, there is a monetary crisis, then there is no plan B for the West. When we see monetary policy play out to its inevitable, messy conclusion, then the East will have considerable wealth relative to those in the West. Now, of course, the West overall might not have a plan B, but that doesn't mean you don't have to. As friend of Goldcore TV, Mark Farber says, be your own central bank. Get out there. Be the Eastern central banks. Buy gold. Buy silver. Don't be without a plan B. And if you're looking for help with plan B, why not tune into one of these videos?